All right, welcome. Let's jump right into one of the biggest, most debated questions in all of personal finance: Roth versus traditional retirement accounts. We've all heard that classic piece of advice, right? If you can pay your taxes later instead of today, you absolutely should. But what if I told you that for the single most important investment of your life, your retirement, that advice isn't just a little off, it's completely, devastatingly wrong? So let's just ask it straight up. We're all trying to lower our tax bill today, right? So this idea of deferring taxes, just kicking that can way, way down the road, it feels like a total no-brainer, an obvious win. But is it really always the smartest play? And you know what? For most things in finance, the answer is a big, fat yes. Delaying a tax payment is almost always a good idea. But there is one massive, absolutely wealth-defining exception to this rule. An exception that, honestly, most people just completely miss. And yep, you guessed it, that exception is your retirement account. This is the one arena where all that conventional wisdom gets completely flipped on its head. See, when you're playing the long game, investing for decades, the rules are just different. And that means your tax strategy has to be different too. Okay, so let's do a super quick breakdown of the two philosophies here. With a traditional account, the whole idea is pay taxes later. You get a tax break on your contributions now, the money grows tax-deferred, but, and this is a big but, you'll pay income tax on every single dollar you take out in retirement. Now, the Roth is the complete opposite. Pay taxes now. You contribute with after-tax money, but then all the growth and all your withdrawals are 100% tax-free, forever. Now, this is where our source material makes a really bold, kind of shocking claim. It says that with retirement accounts, paying taxes later actually sets you up for a massive problem down the road. Think about it. Your assets grow like crazy, which means your retirement income grows, which could launch you into a way higher tax bracket than you're in today. The conclusion is just stunning. Paying your taxes first is what makes you wealthy, and deferring them is what will make you poor. Let's dig in and see how that could possibly be true. Okay, to really get a grip on this, we're going to run a little experiment. A showdown, if you will. We're going to follow one investor over their entire career. They're going to make the exact same investments with the exact same amount of money. The only thing that's different is the type of retirement account they use. So here's the setup. We've got a young investor just starting their career, so they're in a pretty low tax bracket. They're disciplined. They put in $10,000 every single year for 40 years straight. And let's just say they're an amazing investor, pulling in a massive 15% annualized return. Now, pay attention to that high return. It's absolutely the key to this whole thing, as you're about to see. All right, let's hit the fast forward button. We jump ahead to retirement. After 40 years of contributing and a little more time for that money to grow, the traditional account has absolutely exploded. We're talking $8.9 million. I mean, that number looks incredible, right? But here's the catch. Every single cent of that has a tax bill with its name on it. It's basically a giant IOU to the government. Okay, now let's check in on the Roth account. The balance here is $66.1 million. And right now you're probably looking at that and thinking, hang on a second, that's almost 15 million bucks less. The traditional account crushed it. But we've forgotten the most important piece of the puzzle. And this is it. This is the moment of truth. What happens when the tax man finally comes knocking, asking for his cut of that massive $80.9 million? I mean, withdrawing that kind of cash as income is going to put our investor in the absolute highest tax bracket there is. So, after all is said and done, who is really wealthier? And here is the jaw-dropping answer. The Roth investor? They get to walk away with their entire $66.1 million. Every penny is theirs, totally tax-free. But the traditional investor, oh boy, after paying federal and state taxes at a super high rate, we're talking nearly 50% on that kind of income, they're left with just $45.4 million. That's a full one-third less. By trying to dodge a small tax bill when they were young and in a low bracket, they ended up creating a monster tax bill when they were wealthy. Now, if this whole thing feels completely backwards to you, you are not alone. I mean, it goes against everything we're normally taught. So what's going on here? Why is there this huge gap between the math we just saw and what almost everybody believes about retirement accounts? Well, our source offers a pretty blunt, maybe even harsh explanation. It says the entire misunderstanding happens for one simple reason. Most people are frankly not very successful investors. Their returns are just too low, so their accounts never get big enough to create that giant tax problem we just saw. This leads to what you could call a cycle of misunderstanding. It goes like this. You get poor returns, which means you end up with a pretty small retirement fund. So when you retire, you only take out a little bit each year, which keeps you in a low tax bracket. And because your tax bill is so small, you think, hey, that traditional account was a great idea. You completely miss the real reason your taxes were low. It wasn't because of your smart tax strategy, it was because your investments didn't perform. So, if we want to break out of that trap, if we want to start thinking like a truly successful, wealthy investor, what's the big mindset shift we need to make? What's the core principle we need to grab onto? It's actually a really simple, powerful rule. The key to building real wealth is this: pay your taxes first. Just get it done. Get that tax bill out of the way when you're young, when your income is low, and when your tax rate is the lowest it will ever be. Because when you do that, you unleash decades of compounding growth that will be 100% yours. All of it, tax-free. And look, it is so important to get the nuance here. For most other financial stuff, deferring taxes is a great strategy. But your retirement account, that's a different beast altogether. It's a special, long-term engine for creating wealth. It requires you to think differently. You're not planning for this year's tax bill. You're planning for who you're going to be and the assets you're going to have 40 years from now. So as we wrap this up, I'll just leave you with this one question to think about. I want you to look at your own retirement strategy. Really look at it. Are you building true, lasting wealth? Or are you just building a ticking tax time bomb? Are you paying a small, smart price today for a completely tax-free future? Or are you just kicking the can down the road, creating a huge problem for your future self? Honestly, the choice you make right now could be the difference between millions.